this video, we'll be seeing in detail about the primary market. Under this, we'll be seeing about the role of primary market and then the issue of shares, what are all the kinds of issues of shares, and few terms and terminologies like IPO, book building process, price band, prospectus, ADR, GDR, etc. So now let's see why or what is the role of this primary market. So usually the primary markets, it provides a channel for the sale of new securities. We already know that, right? So this is a channel wherein the new issue of securities will be happening. Primary markets provides opportunity to the sellers of the securities or issuers of the securities. So here the issuers may be a government or even it may be a corporates. Okay, they may issue the securities at a face value or at a discount or at a premium. So what is this? Okay, face value. As I said, right? They can issue at a face value. The stated amount or the nominal amount assigned to a security by the issuer. It is actually the original cost of the stock shown on a certificate. It is a face value. Like in the case of 10 rupees, okay, they having 10 printed on it, right? So that is actually the face value of that currency. And similarly, the original cost of a stock, okay, printed on the or okay something shown on a certificate, that is actually the face value of the share or a debenture. And also for bonds, it is the amount paid to the holder at maturity, also known as okay par value or simply par. For equity share, the face value is usually a small amount. Okay. Um, okay. Let's say it could be usually in the denominations of rupees 5 or rupees 10. For debt, the face value is the amount repaid to the investor when the bond matures. Okay. So now let's see the other term that I do. It is the I told like the securities may be issued at a face value or it can be issued at a discount. So it can also be issued at a discount, right? So what is this discount? Uh, Suppose let's say like a security face value is rupees 100. Instead of 100 rupees, if it is sold at rupees 95, then it is sold at a discount. If it is let's say sold at rupees 105, then it is sold at a premium. This is okay the discount and the premium selling of securities. Now let's see about the issue of shares. Why do company need to issue shares to the public? Why we need to issue shares or why the company needs to issue shares? Yes. So why it need to issue shares is because mostly companies okay are usually started privately by the promoters. However, the promoters capital okay the promoters capital as well as let's say the borrowings from the banks and other financial institutions would not be sufficient for setting up or running the business over a long term. So for that, what they will do is they will invite the public to contribute towards their equity box and the issue and they do it by issuing shares to the individual investors. So how to invite them? So the way to invite the share capital from the public is through public issue. So this is how they will do it. They do public issue. A public issue is like an offer to the public to subscribe to the share capital of a company. So once a company allots shares to the applicants as per the prescribed rules and norms laid down by the SEBI, it will be allocated to the individual investor. This is how company issue shares to the public. So in this issuance of shares, there are actually different kinds. So what are all the different kinds of issues? So one, as I said, is okay, the terminology IPO, initial public offering. So it happens when an unlisted company makes either a fresh issue of securities or a offer to the or offer for sale to the public through an offer document. So this is when it happens. And another one is further issue. So fresh issue and further issue. Fresh issue is IPO. Further issue is happens when an already listed company. This is the first time it is getting listed. First time listed. Okay, company is doing these things for the first time. An already listed company. Okay, wants to raise no further capital. Okay, so they make a fresh issue of securities again to the public or an offer for sale to the public through an offer document. So that's what okay further issue means. Another one is a rights issue. So already okay the IPO or through okay further issue. Okay, certain individual investors would have got the shares of the company, right? So the companies would have given them to the investors a share. In the rights issue, what the company will do is the listed company which proposes to issue further okay fresh securities to the shareholders, okay, but they will issue only to the existing shareholder. In this case, there will be new shareholder. There will be an addition of further new shareholders. But in this case, the company issues new securities to the existing shareholder. So rights are normally offered in a particular ratio. Usually, they are offered in a ratio to the number of securities held prior to the issue. It would be like for every new two securities the shareholder is holding, I will give you one security now. Or it could be like for every three securities you are holding, I will give you two securities. In this ratio they will offer. Okay, this route is actually best suited for the companies who would like to raise capital without diluting the okay stake of the shareholders. So the ownership okay won't reduce right in this case. So this is when the company adopts the rights issue. Now let's see about preferential issue, the fourth type of issue. So this is a issue which is neither a rights issue nor a public issue. So neither okay rights issue nor okay public issue. So they are not both okay. Then it is called preferential issue. So it is an issue of shares or of even okay convertible securities by listed companies to a selected group of persons. This is actually given to a selected group of persons who may be known to the companies. Actually, this is a faster way, and why company goes for this is because this is a faster way of raising securities, faster way of getting raising money, or faster way of raising okay, say not securities, a faster way of raising equity capital. The issuer company has to comply with the Companies Act, obviously, in this case also. So thus we have see the classification of issues like this. So if we take issues, it can be a public issue, or it can be a rights issue, or it can be a preferential issue. So in the case of public issue, there can be a IPO, and also there can be FPO, it is further issue. That's what I call FPO, further public offering. So under IPO you can use okay fresh issue, or there will be offer for sale. Same goes for this. There will be fresh issue or there will be offer for sale. So now that we have seen all these things, let's see what is called issue price. What is issue price? The price at which a company's shares are offered initially in the private market. Public primary market. So when the in the primary market, the company issues first the shares, right? What price it is actually introducing, that is called the issue price. But however, when it is traded in the market, It can be above the issue price, okay, or it can be below the issue price. Any of the two scenario may happen. And there is one more term that I want to share with you that is actually called market capitalization, or okay, MCAP, we call it in short term. So what is this market capitalization? The market value of a quoted company is actually calculated by multiplying the current share price, that is the market price, with the number of shares issued to the public. This is called market capitalization. Let's say like a company XYZ has around, okay, 120 million shares, okay, 120 million shares in its issues, and the current market price of the share is 100 rupees, and the market capitalization of the company is 12,000 million, or I would say 12,000 into 10 power 6 rupees. This is the market capitalization of the company. Now let's see about the difference between the public issue and there is something called private placement or preferential, something like that, right? These are preferential issue. We already know when the issue is made not only to a selected set of people, okay, that is called private, but also to a public, then it is a public issue. But if the issue is made only to a selected set of people, that is called a preferential issue or private placement. That is the difference. Actually, as per the Companies Act, if you would say a issue becomes public if it results in the allotment of 50 persons or more, 50 or 50 plus, then it is a public issue according to the Companies Act. The next term I want to share with you is IPO. Already I told IPO is the selling of securities to the public in the primary market. It is when an unlisted company makes either a fresh issue or an offer for sale of its existing securities, or both for the first time to the public. So in this case, the point I want to actually stress in this part is what should be the price of the issue, or who decides the price of the issue. The price of the issue will be usually decided in two ways. One, it will be decided by the company as well as the lead merchant banker. So a merchant banker will take this, okay, share and sell in the market, that is called lead merchant banker. So either they can decide in this way, or what they can do is they can fix these two people, they can fix a price, or these two people, the company plus lead merchant banker, can give it to the market after deciding the floor price. They will actually decide a floor price and they will roll it to the market to determine the final price. So the point here is they will decide the floor price and then the market will decide the final price. Here they will fix the final price itself, but in this case, first the floor price is a minimum price of the security. They will decide first and they will roll it to the market to find how much demand, how much premium the customer is okay ready to pay for it, or discount the customer is paying for it. It is actually being decided in the market. So these are the two ways the price of the issue will be decided. So how does the price discovery happens? Through book building process. Book building is basically, yeah, sorry for the disturbance. So book building is basically a process used in the IPOs for the efficient price discovery. So it is a mechanism where the IPO is, it's a mechanism which happens during when the IPO is open, where the bids are collected from the investors at the various prices which are above or equal to the floor price. The offer price is determined after the bid closing date. Actually, okay, whenever IPO happens, I said right, they will decide the floor price and they will give it to the market for deciding the final price. So this is called actually the book building process. So another thing that we have to see is what is the difference between the offer of shares through book building and the offer of shares through normal publication. So in the case of shares through book building, okay, uh, the price at which the security is allotted is not known. Price is not known. But in the case of this thing, offer of shares through public issue, the price is known in advance to the investor. Under book building, as I said, the floor price will be given. That's the reason why it is not known. First, the floor price will be given, and then only the final price will be decided. Okay, so that's the reason why this thing. Okay, the price is not known. And one more thing that we are going to tell here is the demand can be known every day in the case of book building, but in the offer for public issue, the demand will be known at the close of the issue. Another thing that I want to say here is there is something called cutoff price. What is this cutoff price? So cutoff price, I usually okay, it happens in a book building issue. The issuer is required to indicate either the price band or a floor price. Okay, the price band usually will be um, actually 20 percentage plus or minus 20 percentage. Either he can do this or he can give the floor price, right? The actual discovered price can be any price in the price band. Okay, the final price can be any price in the price band, or it can be any price above or below this floor price. And this issue price is called the cutoff price. These two are called the cutoff price. This is another terminology that is being used. And of course, who decides? Now comes other question like who decides these two things? As I already told, it is being done by company as well as the lead merchant bankers. These two people will decide this thing. And what is the minimum number of days for which a bid must remain open under the book building? Yeah, I told okay there will be something called okay floor price and then the final price. So for how long this will happen from floor price to final price? It usually happens in a minimum of 3 days. Okay. Um, yeah, and obviously the individual investor can participate in okay in the bidding process to decide the final price. So okay, that is one thing. Uh, Another thing is once we decide this okay final price only it will get listed in the share market. Okay, how many days it will take to get listed in the share market? It will take okay 12 working days to get listed in the share market according to Indian norms. And there is some person called registrar in this issue. Oh, let's see what is the role of this registrar. The registrar actually finalizes the list of the eligible allottees, like which person can are eligible to a capital for getting okay share from the company in the IPO. This will be decided by the registrar, and he takes care of every action right from the okay, issue of getting right from the receivable of application to the dispatch of the refund orders to those applicants are sent. Usually, the lead manager coordinates. The lead manager is nothing but from the lead merchant bank. There will be lead manager. He will be coordinating with the registrar, and both of them will decide okay and ensure that the eligible allottees are okay properly treated in this IPO process. And one more thing that I want to discuss in this is prospectus. There's something called prospectus in okay, whenever any issue, new issue is made in the primary market. So that is usually right. A large number of companies float public issues, while a large number of these companies may be okay genuine, whereas a few of them will try to exploit the investors. Therefore, it is very important that one investor before applying for any security, they must do some research on the company in terms of finding the future potential. Um, and also, SEBA has also given guidelines. So to make this research okay, easy, SEBA has given guidelines to the companies who are issuing the shares to disclose some information to the public. So investors, in fact, can okay refer this information to make the participation educated participation. The disclosure usually includes information like what are all the informations, yeah, that will be included. It usually includes information like what is the reason for raising money and how the money will be spent. All these things will be written, like for what purpose, whether for expansion purpose or for or for diversification or for reinvestment. Okay, these things will be actually told, and also how much return on investment you as investor will be getting if they actually opt for this. So this is called prospectus, a disclosed information which is revealing the reason for okay raising the money and how the money will be spent and what will be the return on investment. All this information is called actually uh, okay the prospectus. And also apart from this, it also includes the size of the issue, okay, and also the status of the company right now, and also it will tell about the equity capital and its performance in the past. All those things will be there. uh, Mostly it contains a lot of mandatory information regarding like underwriting and statutory compliances. So these are some of the information which SCBA actually mandates the company which is issuing these securities to the market, so like the investors will take an educated um, risk before investing in those companies. This is called the prospectus. And another thing that I want to say is like there is a short, okay, a miniature version of prospectus called arbitrage prospectus. It's nothing but the prospectus only, but it is short form. It contains the salient features. It's a very small document which contains okay salient features of the okay prospectus. And one more term is called lock-in. What is lock-in? So lock-in is a freeze on the sale of the shares. Usually, this is done by SEBI to protect the interest of the promoters. Yeah, so that the investors will continue to have a controlling position in the company because by this freezing on the sale of the shares, they continue to hold some minimum percentage in the company in terms of like minimum percentage of holding shares, minimum percentage of shares they're holding under their control even after the public issue. This is called lock-in. This is the freeze on the sale of the shares. And also one must know what is called listing of securities and delisting of securities. Listing and delisting. This is another okay quite important terms. So listing means okay whenever security issuer uh, wants a trading privilege to happen, that is like buy and sell of let's say Tata Motors to happen in a stock exchange, then you must get a securities listed. That is called listing of securities. That means you will be actually listed in the exchange house so that the people will have the trading privileges, that is the buy and sell privileges on the securities. So it is in fact the prime objective of okay the listing of securities is to provide liquidity and marketability to securities. That is one of the major things, liquidity and marketability. These two things will happen once you list the securities. Whereas if you do delisting, your trading privileges will be revoked. That means you will be removed from the stock exchange. That means your stocks will be no longer traded at the stock exchange. Okay, this is what delisting and listing means. And one more thing is, what does SEBI do is in this issue? Usually, SEBI doesn't guarantee what to say, like the issuing companies are genuine or not. It's up to the investors to take the educated guess or educated risk in the form of going to the prospectus. But however, SEBI takes a voluntary intervention of for companies that is going to get capital or raise capital more than 50 lakhs through this publication. So that is one of the major thing that SEBI is doing. Again, doesn't mean that the SEBI is guaranteeing you that the the verification they done for the company which is issuing more than 50 lakhs is genuine or not. They just okay they're just doing the scrutinizing process here to ensure that the issue is the issuing companies is having adequate disclosures in the prospectus so that the investors who are going to the prospectus will be protected. This is the protection of the investor. But one must not assume that SEBI is actually giving or making one's money safe by doing this. Now let's see the final few more terms like ADR or ADS and GDR. So ADR stands for American Depository Receipts and GDR stands for Global Depository Receipts. So before that, what are these things? Like what are this ADR and GDR? These are the way of raising money in the foreign countries. Okay, so usually some companies prefer to raise capital instead of there is capital from the primary market which will be in the foreign countries. If it is, let's say, like raised in USA, then it is called ADR, and if it is raised in countries apart from USA, it is called GDR, Global Depository Receipts or Global Depository Shares. So both of the terms can be used interchangeably. Both means one and the same. In India, Infosys is one such company to do this for the first time. They issued ADR, and few other companies like MakeMyTrip.com also as equity market, which is mostly issued in the American market in the form of ADR. So it is a way of raising money in the foreign market. So what happens in this American depository share or American depository receipts? Usually the American citizens, they can subscribe to or they can buy the shares of non-US based companies in the form of American depository shares or American depository receipts. This will be sold by some depository banks like JP Morgan Chase. Okay, they will do these things, and they are actually traded in the same manner as shares in the US companies. That is, they will be listed in the New York Stock Exchange or even the American Stock Exchange (MX), or maybe they'll be quoted on the Nasdaq, or maybe in the OTC market also, over the counter market. So, however, this does not, and obviously, if you raise money, right, money from the foreign, we are exposed to something called currency risk. If the currency depreciates, if US money depreciates and the Indian money appreciates, then the Indian companies will face loss. So those things are not covered here. So they are exposed to this currency risk. That's another one I want to say. And similarly, the same mechanism, if it happens in countries other than the America or US, it is called global depository receipts. The underlying shares actually in the global depository receipts are on a fixed ratio. Let's say like it doesn't mean like if I buy one ADS, it means like I'm buying one share of a particular company or one share of Infosys. It's not like that. It could mean, okay, it is always in a particular ratio. That means one GDR is equal to 10 shares, or one ADR it may be equal to 5 shares. They are actually sold in a bulk form, and that is as far as this primary market is concerned. And thank you for watching this.